Good day, girls. I hope all of you have been able to work out and find out the value of redeemable debentures. That is problem number 2 and problem number 3. We discussed the relationship between the coupon interest rate and the expected rate of return of the investor and correlated it with what happens to the present value vis-a-vis the face value. Let's now move on to another type of debenture. Now, the second debenture that we are going to discuss today is the debentures which are redeemable in installments. Now, in case of a debenture which is redeemable in installments, we must remember that every year the company is not just paying the coupon interest, but is also repaying part of the principal. Okay, part of the principal. That means the total face value, assuming that the company is paying back the face value after say 5 years, then the face value of the debenture which is repayable at the end of the period, at the end of the term, is divided by the number of years in order to find out how much is the part principal that is repayable at the end of each year. Okay, so this would be a very important aspect that we have to keep in mind, because the debenture is redeemable in installments. So, when it is redeemable in installments, let us say at the end of the, let us say for example that out of 100 rupees, if 20 rupees is repaid at the end of year 1, then for the next period the outstanding amount on which interest will be calculated will be only 80 rupees. So, therefore, the coupon interest rate would be reducing depending on the amount outstanding at the end of each year. Okay, so let's pick up a problem and let us work it out. So please go through the problem that is there with you, and let's see what sense we make out of it. A company proposes to issue a 5-year debenture. So number of years is 5. Again, face value is 1000, redeemable in equal installments. Okay. So, when it is redeemable in equal installments, we must remember that the part of the principal that is being repaid at the end of each year will be calculated by taking the face value, which is 1000 in our problem, divided by number of years being 5. Therefore, the part principal that is being repaid every year from year 1 to year 5 would be an amount of 200. So, when 200 is paid 5 years, every year 200, so 200 into 5 would be 1000. That's right. So, how do we go about understanding the calculation of the interest? If you can see the table that is there in front of you, the amount that is outstanding starts with 1000 rupees at the beginning of the period. So, when there is a full 5-year term, the debenture face value is taken at 1000 rupees sorry, and this 1000 at the end of the same year, at the end of year 1, when you divide and you 1000 divided by 5, the part amount that is repaid is 200. So, please refer to column 4. You have 200 rupees being repaid at the end of each year for 5 years. So, at the end of the 5th year, there is nothing remaining to be paid off. Everything has been paid in installments, right? This is the meaning of equal installments, where the debenture is being redeemed in a given number of installments based on the number of years. So, 1000 rupees has been repaid as 200, 200, 200, 200 and 200. That's what we have understood here. Okay. Now, when you talk of the coupon interest, in the previous problems I have already told you all that coupon interest is calculated on the on the par value or on the face value. So 1000 rupees at the rate of 14% would be 140. This 140 is paid in the beginning, then 200 is paid at the end of, let me rephrase that. 140 rupees is paid at the end of year 1 in terms of interest on 1000 rupees, and 200 rupees part principal is being repaid. So the total amount of cash flow that is reaching the investor from the company at the end of year 1 is 200 plus 140, which is 340. Okay. Then when you look at the amount outstanding for the next year, please do not worry about the interest component. Please look at the principal component, column 2 and column 4. 1000 rupees minus the part principal which has already been paid. So 1000 minus 200 would be 800. 800 at the end of the second year, again one 200 goes out, therefore it becomes 600 in the beginning of year 3. At the end of year 3, 200 is again repaid. So the amount outstanding at the beginning of year 4 is 400. Then at the end of the fourth year, 200 is paid. Therefore, the amount outstanding at the beginning of the fifth year is 200. End of the fifth year, 200 is repaid in full. So this is how column 2 and column 4, you will have to understand that the amount in the second column progressively reduces based on the number of part principal payments made at the end of each year. Got it? Okay. So this is one aspect that you will have to remember. How did you arrive at 200? Go back to the beginning. I told you all, the part principal is calculated by dividing the face value of the debenture by n. N represents what? Number of years. Right. So now keeping this in mind, let's look at the coupon interest. In the beginning, when we were solving redeemable debentures, we understood that coupon interest is the rate of interest paid on the debentures by the company as a part of the terms and conditions at the time of issue of the debentures to the public. So in this problem, the coupon rate happens to be 14%, right? So 14% we calculate on 1000 rupees, because 1000 rupees is the amount outstanding for year 1. So that would be 140 rupees. That's how you added interest and principal to get the cash flow of 340. Okay. But if you look at year 2, in the second year, the amount outstanding is not 1000, right? So because already 200 rupees from 1000 has gone back to the investor, so the interest calculation will be on reducing or diminishing balance method. I'm sure all of you remember that. So that would be 14% on 800. 14% on 800 would give you around 112. So 112 plus 200 would give you the cash flow of 312. Notice how the amounts in the second column and the amounts in the third column are reducing, because there is a part principal that is being paid off at the end of each year. Okay. Then let's again, to reiterate, from 800, at the end of the second year we have paid off 200. Therefore, the amount outstanding in the beginning of the third year has come down to 600. Yes. On 600 we pay interest at the rate of 14%. So that would amount to around 84 rupees. Okay. So 200 is being repaid back from that 600. So therefore, you have a situation where the amount outstanding in the beginning of the fourth year will now come down to 400 rupees. The interest is calculated on that 400 at the rate of 56 rupees. Then 200 more is paid back at the end of the fourth year. Therefore, in the beginning of the fifth year, there is just 200 rupees outstanding, on which 14% is calculated, 28 rupees. And then at the end of the year, 200 is fully paid off. So there is no more obligation for any other payment to be made by the company. So the cash flows are taken in column fifth column, and these cash flows are, what should we do with them? We have to discount those expected cash flows at the appropriate present value factor. Go back to the beginning of the problem. The investor's expected rate of return is how much? Yes, it is 12%. So at 12%, girls, you all should remember the PVF is arrived at by applying the simple 1 divided by 1 plus 0.12, which means 1 divided by 1.12. When you press this equal to sign in your calculator, you will get for year 1, then you will keep getting it for the remaining years. So since you're familiar with that, I think we should move on. Then you multiply the cash flows at the end of each year with the respective PVF, and you will get the discounted cash flows. Do the summation of the discounted cash flows, and you will find that you will get the present value of the debenture. So when a debenture is redeemable in installments, the face value being 1000 rupees, the present value is 1046.32. Go back to what I told you all as a general relationship. What did we discuss in the previous session? We understood that the investor's expected rate of return is 12%, but the company is offering and giving how much? 14%. That means the company is offering a higher rate than what is expected by the investor. So in such a case, because he is getting more than what he expects, the present value is higher than the face value. Please remember the generalization that we drew based on examples and based on the previous problem. So this is a slightly different problem, but please read the wordings in the problem. Don't just read that the debenture is redeemable and jump to any conclusion. You must read whether it is redeemable and the wording is specific, whether it says in equal installments. If it says installments, then you have to underline that word, not in the book but in your mind, and you will have to go forward to work it out. So please do this second problem. There is a new word there, not really new, you would have learnt about it even in depreciation. Debenture will be amortized. That means it is repayable in equal installments. So please work out that problem, and you will be able to get a grip on how the calculations will be done for outstanding amount at the beginning of each year. Girls, don't let any exercise or any assignment pile up. Please keep doing it as and when you finish the session or as you complete it. Ensure that you have worked out that particular problem and then work out the exercise problem so that you get a clarity on how the whole thing works. Imagine that you are actually doing it in front of me. Okay? Alright. So now that is one aspect, and then we will also look at what is the valuation in case of a deep discount bond. Valuation of a deep discount bond. Now a deep discount bond is one which is offered by the company to the public at a discount. Okay. So to give you a very simplified example, 100 rupees face value bond may be offered to the public at a discounted price of, let us say, 60 rupees. So it is available, people can buy it at 60 rupees now, and then there is a term for maturity, maybe 5 or 8 or 10 years or whatever. So depending on the term, depending on the number of years, at the end of the term specified by the company promises to pay back the face value. So you're paying 60 and then the money gets locked up with the company for a given specific time period. At the end of the time period, the company will pay back the face value. In this case, 60 rupees you have paid, you have locked yourself in for the term period of, let us say, 4 years. Okay, and then at the end of the 4th year, you get back your face value of 100. So there is no periodic interest payment made by the company in the case of a deep discount bond. Therefore, it is also called by people as a zero coupon bond. This is also one of the terms. A zero coupon bond is a bond on which no interest is paid, but it is offered at a discounted price, and at the end of a particular time period, the face value of the bond is repaid back to the investor. So there is only one cash flow from the company to the investor at the time of maturity of the bond. So upon maturity, the investor will get back the face value. So in this case, the value of a deep discount bond is its face value into the appropriate present value discount factor. So let's work out a problem to understand the process. Take the problem, girls. It's right in front of you. I hope you have kept it ready. A deep discount bond is issued with a maturity period. That means term is how many years? 20 years, right? Term is 20 years. And it carries a face value of 1 lakh. So after 20 years, at the end of 20 years, the company will pay back 1 lakh. Find out its present value if the required rate of return is 10%. So let us say I, according to our formula, present value discount, let's go back here, face value into present value discount factor. Below F, you have a small I, you have a small n. I represents the required rate of return, and n obviously would represent the number of years. So when you have to look at the present value factor, face value all of you know, when you look at the present value factor, you are looking for which factor? For 10%, which year? You have to leave out year 1, 2, 3, 4 like that. You go to the 20th year, and the 20th year present value factor, whatever it is, you multiply with, you multiply it, or you have to take it into account, face value into present value factor. So if you go down and check the present value factor at 10%, in the 20th year it is around 0.1485 or 86, it would be somewhere here. So this 0.1486 is multiplied with 1 lakh, and this amount 14,860. That means, what does this mean? It means that this particular investor, for him, with his expected rate of return of 10%, today if this particular deep discount bond is available at this price, he will not mind buying it because it suits his required rate of return. He is willing to get a face value of 1 lakh after 20 years. Okay. For him, the present value is so much. So if the debenture is available either at 14,860 or lesser than that, it is ideal, it would be better suited for this investor, and he will be able to purchase it. So a deep discount bond doesn't have any interest calculation, it doesn't have any part principal payment calculation. There is a totally simple one-time formula that we use. It is nothing but the face value into present value discount factor, taking into account I is your required rate of return, n is the number of years. So this is a small calculation that we do, and these are small problems. We just check whether you know what a deep discount bond is and how its present value has to be calculated. Okay. So we move on now to the next problem. Obviously, I would want all of you, I would request all of you to work it out. Okay. Now these are all the next, just like the deep discount bond, we have another category of bonds called perpetual bonds. Perpetual is also known as irredeemable, so you can call them perpetual debentures. A debenture which is not going to be repaid during the lifetime of the company, but on which perpetual interest is going to be paid, then we refer to it as a perpetual debenture. So the present value calculation is a simple R divided by K. K is your required rate of return, okay, and R happens to be the interest that the company is paying per annum. So Very simple, girls. These are like 1 markers. X has a perpetual bond of face value 1000. We don't need to know the face value of a perpetual bond because the company is not going to pay this unless it goes into liquidation. So X has a perpetual bond. Let's not worry about the face value. It is given there, no doubt, but let's ignore it for the time being. He receives interest of 60 rupees per annum. Now this is important because that is referred to as R. Every year interest is 60. So what is the present value if the required rate of return is 10%? Okay, 10%, make it a decimal. 60 divided by this much, the present value would be a sum of 600 rupees. That's it. Okay, and then there is a similar problem, the second one. Go ahead and work it out. The first one I have shown you, the second one. These are not at all difficult, but they are important in terms of knowing the formula and just applying it. Okay, so the second one you will have to do it. The third one, let me pick it up. R has a perpetual debenture of face value. Once again, I don't need the face value as I explained to you. If the present value of the bond is, so the present value is equal to R divided by K. Present value is given to us in the problem as 1200 is equal to R is 80 divided by K. So cross multiply 1200 K is equal to 80, K is equal to 80 divided by 1200. Find out what it gives you, around 6.67. Now when the present value is given to us, okay, and when we are given R and we have to find out the required rate of return, then the calculation of K, when you instead of using the word K here, we can also call this as yield to maturity. Okay, what do we refer to it as? We refer to it as yield to maturity. When we are asked to calculate the required rate of return and the other variables are provided here, the K represents something called as yield to maturity. Okay, so sometimes textbooks may refer to it as yield to maturity. Now PV into K is equal to R. K is equal to R divided by PV, right? So yield to maturity is referred to as R, that is your interest, divided by the present value. So there is a sum on that. I am sure all of you can just substitute and find out. It is a very simple sitter. What you need to do is just apply that formula. YTM is equal to R divided by PV. So do go ahead and do it. Okay, right. So this is for now. My idea is for you to become more familiar with the different categories of debentures where we calculated the present value. We close at this point this particular session and we'll continue the next. Okay, see you girls. Bye.